Well, another week and another rally to all-time highs in equities. I'm here to bring somebody to you to break this all down. I'm bringing Mr. Jim Welsh from Macro Tides, and let's talk about what in the heck is going on, Jim. Markets are still ripping here. What do we do? What do we do with all this?
Well, again, the underlying technicals for the stock market have really been constructive. We've talked in recent weeks about the advanced decline line, which I
Yes.
think is a one, if not the best. If you had only one indicator to watch the stock market, that might be the one. That has continued to make higher highs, and that typically points the direction. Just like in February when the S&P was making higher highs, the AD line wasn't. It was below where it was last November, and that provided a really good warning. And then it just always comes down to, what kind of reason to sell materializes. And if it's a good one, you get a big decline.
Well,
Right now, it's a combination, Blake, I think, that people don't feel there's a reason to sell.
okay. Yeah, I was
And
I was gonna
so
say I was gonna ask actually. So in the slides that you bring. And I mean, last week you were talking about the AD line and how powerful it was and how it's just suggesting that the markets are going to continue higher. And here we are. The markets are just grinding higher. Is there anything on the horizon that you see as a risk to the current market environment?
I would say two things. One is there's a fair degree, I think, of complacency regarding inflation because we had two CPI reports for April and May, and there was really virtually no tariff inflation bleeding through. I think over the next 3 months, we're going to start to see progressively more tariff inflation feed in. Remember, the CEO from Walmart in May said, yeah, we raised prices, but we're going to raise them even more in June. We know there was a huge amount of inventory that was bought. Really, it started in November after the election. Obviously, really picked up as we got into January, February, and March. The trade deficit went from 79 billion in October of last year to I think about 160 billion. So we know there was a lot of stuff that was bought sitting on shelves, and that's why I use the word progressively. We'll see the tariff inflation bleed through because as those inventories are worked down, we're going to see goods that were bought in May and June at higher tariff rates. And I think companies are going to respond. Last week, I noted a survey that was done by this Atlanta Federal Reserve. And what they said was that companies, whether it be a 10% tariff or 25, were planning on raising prices by almost half of them were planning on raising prices. So I think, there's a willingness for companies to raise prices. The other thing that also has come to light is companies that aren't directly importing stuff, Blake, but they have competitors who do.
Yeah.
And those companies now have the cover of, while they're raising their prices, we can, afford then to raise our prices less than theirs. And so I think there's some of that companies taking advantage of the environment as well. So the bottom line is, I think we're going to see more tariff inflation progressively in coming months as inventories are worked off and companies start raising prices.
Jim, and we're going to get into your slide. I think your first slide's really, really great here. But one of the things about what's different about now than it was in 2017. 2017, companies were afraid to raise
Yes,
prices, but today they know it can be done, and they know consumerism hasn't slowed down, so they have that free reign to explore where they didn't
yeah,
have it before.
that is a huge point, Blake, because back in 2017, in terms of the psychological shift that's happened inside companies, you were afraid if I raise prices and my competitor doesn't, I'm going to lose market share because we had just had an extended period of really, really low inflation. Well, we just went through a big inflation bubble. And to your point, companies were able to raise prices and the willingness and the tendency is in that direction. I think we can raise prices. They're doing it gradually or whatever it is. And companies under that cover, I think, are joining in the parade. So the psychology is so different and consumers, as you pointed out in 2017 and 18, somebody raised prices, consumers immediately noticed and balked. Now you go and you say, geez, I can't believe that's up again. But you accept it because we've been conditioned the last 3 years to accept higher prices.
Yeah.
So
Yeah.
I just think the complacency on inflation, to answer your question, what's a risk? The risk is that the inflationary pop that's coming is more than what people are expecting at this point in time. And obviously, if that proves true, it has an implication for monetary policy.
Well, next, I know in a couple of slides you're going to talk about next week's CPI data. So let's go
Yeah,
ahead and break it
yeah.
down, Jim, and let's go into your first slide, which I think is quite interesting and cute. So, what do we have here?
And cute and also really good, at least from my vantage point. So I just saw this week, and I've seen it before in years past. And I just thought, you know what? If you want to have a clean definition of different type of economic systems, this does a great way of breaking it down, making it simple so you can truly understand it. And what prompted me, Blake, is reading more and more about Gen Zs, people in their 20s are much more accepting, embracing of socialism. And I get it. For people in their 20s, you have student debt. You're living with mom and dad still. You never thought that was going to happen. It's tough to get a job. So, capitalism hasn't been working for a lot of people in their 20s and early 30s. But socialism, you have two cows, the government gives one cow to your neighbor. Okay. Communism, you have two cows. Uh, you have to give both of your cows to the government, and they may give you some of the milk. Fascism, you have two cows. You give all the milk to the government, and the government sells it. Nazism, you have two cows. The government shoots you and takes both of your cows. Anarchism, you have two cows. Keep both of the cows, shoot the government agent, and steal another cow. I mean, it's like, just complete revolt. And then finally, capitalism. You have two cows, you sell one and buy a bull. And that is the difference here. Where is the incentive to increase production in all the other, definitions? It's not really there. And that's, a person has to take the risk. I'm going to sell my two cows, buy a bull, probably out of pocket a little bit too, on the hopes that, all right, I'm going to grow a herd, and I have a herd of cows that's going to increase income. And guess what? It's also going to supply the area you live with more milk. And so there's a lot of faults with capitalism. So I'm not one of these like, okay, capitalism perfect. People say, well, it's driven by the market, but that doesn't mean there aren't imbalances. You look in the late 90s, early 2000 in terms of how much capital was raised about the founding of the internet and all the rest of that. And so many companies went belly up. Valuations were ridiculous. So it's not like capitalism has the perfect record of allocating capital, because people allocate capital and sometimes they make mistakes. But over time and in aggregate, if there's a reward for people to come up with good ideas that help people, improve people's lives, capitalism is the way that does it better than all the other approaches. So when I hear, oh, we don't want any billionaires, well, look at Amazon. I think there's 1.2 million people who have a job because of Amazon. Apple's about 175,000 people have good, in Apple's case, really good paying jobs.
Yeah.
So yeah, stocks go up, and guess what? Pension funds own those stocks. That helps people with their retirements. So I just think, unfortunately, when you go to colleges in the last 20 years with tenured professors and they're preaching about socialism and communism and how wonderful it is, it's kind of ironic with a tenured position and having really virtually no risk and probably never created a job in their life to be teaching young people, yeah, this is so much better than that capital. Greed is awful, So anyway, I just saw this definition and, to me, it works. So
Yeah. All right. Well, then the next chart you brought is talking
yes,
about effective tariff
back
rates.
to the regular scheduled program.
Right, right, right. So,
So again, this is the effective tariff rate, and it's like a bouncing ball. It keeps changing, right? So, July 9th was the day. Well, President Trump didn't wait for July 9th. It's like over the weekend. Okay, I'm going to hit Japan with 25%, South Korea. Uh, we import 152 billion in last year from Japan, 138, so it's not insignificant. Okay, yesterday I'm going to hit Brazil with 50%. Well, we imported 42 billion. We might have a surplus with Brazil, but we still have a decent amount of goods. So, my point is that 2 weeks ago, the tariff rate was about 12.3. Now it's over 15. And at the beginning of this year was 2.3%. So again, my point is we've seen a huge increase in tariffs and companies showing a willingness to pass along some of those costs. It's hard for me not to believe that it isn't going to show up in inflation in a more, serious way than people are expecting. All right, next week is the CPI. I can't remember if it's Tuesday or Wednesday, but what I want you to look at is
I believe it's on Tuesday, but let me confirm that. Go ahead.
We want to be factual here. All right, so May of 24, you can see that the takeaway value for June of 24, the takeaway value on the headline was 0 basis points. So whatever the CPI is for June, this annual rate is going to go up. So if it's 1/10, it's go up by 1/10. If it's 2/10, it'll go up by 2/10. The core was 9 basis points. So I've been pounding the table here that the takeaway values for June and July and even into August are really pretty low, and that we're likely to see the annual inflation rate go up by at least 0.3%. So, decent number from 2.3 up to 2.6, maybe higher. The core from 2.8 to over 3. So and the August read will get reported in mid-September. So again, I just think there's a lot of complacency, Blake, regarding inflation. These numbers, along with companies' willingness to actually pass along the tariffs and the level of tariffs being so high, if they're maintained, it's hard not to believe we're going to see potentially a more serious bump to inflation. And I think that has the potential of rattling the stock market because it will put the Fed on hold for a longer period of time.
Yeah.
And if it's like 6 or 7/10, let's just say over the next 3 months, it pops by 6/10, there'll be people coming out of the woodwork. Well, maybe the Fed should be raising rates. I think the chances of that are near 0. But again, markets react to, narratives. So we'll see. That to me is the biggest potential negative surprise.
All right. So this one is on registered investment advisors. Tell us what we're seeing.
Yeah, it's an organization, National Association of Active Investment Advisors. And what this does is every week, and it's free, you can find this and track it yourself. And again, this is a sentiment indicator. And when exposure is really low, obviously people are negative. And when it's really high, they're really positive. And so historically, when this gets up near 100%, and it can actually go over 100% because some advisors will include some leverage. But my point is showing over the last 18 months or so, you can see back in March, it got up to 100%. The S&P subsequently lost or pulled back 5.9. July, 9.7. November, 5.4. So,
we are levels
we're there
that you're getting extreme sentiment, which could give us a near-term setback.
Yeah, I mean, and again, I don't think 9.7 is in the card unless the inflation news is so bad that Treasury yields, that's the other risk, Blake, is that the Treasury yields take out their October of 2023 highs. So the 30-year was 5.15 and the 10-year was just below 5%. So if that doesn't happen, I just think you can have a garden variety pullback that's somewhere between the 3 to 7% range, and possibly more, but you're going to need, a bigger trigger to get people to think, yeah, maybe I should take some chips off the table.
Garden salad variety. I like it. Okay. So, the S&P advanced decline line, you were just talking about it, and it's what we're seeing here versus last week.
Yeah, and as I said before, we've talked about this before, the advanced decline line in February, you can see was comfortably below where it was last November. The S&P was making a higher high, and that's always a warning sign, that you're vulnerable to a decline, whether it's 3, 7, or 15% is all dependent on the reason to sell that materializes. The fact that it broke out and has continued to climb is why I thought the S&P would rally to a new high above 6147, and why in this last Monday's weekly technical review, my expectation was the S&P would rally above the 6283.84 high that we saw, I think, earlier this week. So my take on this is longer term, this is constructive in terms of, okay, doesn't mean the market can't have a 3 to 7% pullback. It just raises the probability that after that pullback, the market is going higher.
Got it.
So that's my take.
All right. Well, the next chart is TLT. You now, uh, um, we saw a rally. Yours doesn't look the same as the way I'm looking at it, and I'll just kind of see if I can give you a rough draft drawing of what I'm looking at. I was looking at a channel that looks a little bit different. It looks like this to this. And this happened there.
Yeah.
The 200 DMAs happens to be right here. So we've seen this rally, but that rally really came after yesterday's 10-year auction, and then we had a 30-year auction, which wasn't really that great today, but still, we're seeing a bounce in TLT. We're seeing a bounce in bonds. But
Yeah.
where does
Yields
that
coming
leave?
down.
Where's that leave us, Jim?
Well, again, I think the longer term trend in treasury yields is up. So that's the major trend, like all out over the next number of years.
So that
So
means
now we're just trying to
that means
deal with the
TLT
short.
should go down.
Yes.
Yes.
So
Okay.
ultimately, do I think TLT is going below 83.29? Yes, I do. And then below 82 because that was the low in October of 2023. Near term, you can see there was a nice little red trend line that was kind of holding this rally. We closed below that earlier this week. I think potentially all we're doing, Blake, is bouncing back to the underside of that red trend line. Also, it's possible that the rebound from the low that we saw a couple months ago at that 83.29, that the rebound towards 88 and change was wave A. This is a pullback for a B. And then, so there's still the chance you could see 88, something above that 88.43. But again, for me, the longer term trend, I think, is in treasury yields is higher, and the inflation news is going to deteriorate. How the bond market is going to handle that will tell us a lot. But it was oversold. You just noted the 200-day average, so an obvious place for some support to come in. And I think that's all we're doing is we're getting a bounce after a sharp little sell-off. And I think after this bounce, whether it gets above 83, 43, or 88, pardon me, 43 or not, I think when this bounce ends, we're going to lower lows.
Okay. All right. Fair enough. Now the dollar. Uh, you've been looking for a bottom somewhere around here. I myself have seen the signs. Think sentiment's pretty negative. The dollar. How do you feel about where we're currently at?
Well, it's possible we saw the low at 96.37. You had a huge RSI divergence on that lower price low. I mean, the RSI back in April was 21. Last week, when it got to the low, it was 31. I mean, that's
Yes.
an enormous divergence. The five, which is the red moving average exponential, is close to crossing above the green line. So that again would say, all right, momentum is starting to improve. That red trend line is obviously pretty important in terms of, the dollar getting above. And as you noted, sentiment is negative. And because negative sentiment is so negative, positioning is really, really negative. I mean, there's a lot of people that are short the dollar and or long other currencies because they think it's going to continue to go down. I just think everything blended in, Blake, a rally up towards 104 to 106. And we'll see if that rally, if we get that rally and it's five waves, then all of a sudden we'll be talking about getting above 110. So one right here is one step at a time. My
Yeah.
take has been it's not a place to be short, and I think the next larger move is to the upside.
All right. All right, Jim. I'm glad we're on the same page as far as the dollar goes. Last but not least, you have the gold market. I mean, this gold
Yep.
market's been, we talked about it last week about it being a little vulnerable. Even though we're still, kind of drifting lower, we haven't seen any type of any aggressive capitulation type of selling.
No.
This has been a very much a grind. So how
Yeah,
do you
yeah.
feel?
Well, again, I think potentially gold is going to drop below that recent low at 32.56, but hold above 31.27. So this has the earmarks of a triangle. A, B up to 34.49, wave C, I think, and within a triangle in terms of Elliott, they're all three waves. Up, down, up, down, that kind of stuff. I think we're seeing within wave C down, a bounce, and then I think we're going to see another down. As I said, above 31.27. Then wave D will be a three-wave rally that won't get above 34.49. And wave E will be a three-wave decline that will hold above whatever the low proves to be for wave C. It just wears you out. Triangles are just a pain in the butt because so much chopping is happening. But what happens is over time that starts to erode bullishness, and slowly but surely the excess long positioning, which certainly was the case when gold traded up to 34.96, slowly
Yeah.
but surely as people just get worn out, the long positions get pared back. And then that sets the table for what I think is going to be a wave five that will take gold comfortably above 3,500. But we could be 3 months away from finishing this, what I think is triangle. The other account is potentially gold drops below 31.27, and that forms the bottom. I just think that given the sentiment, everything that's going on with trade and everything else, that we're more likely to keep chopping sideways.
Well, Jim, I didn't like to hear that chopping sideways, but then again, it's summertime. We have to keep that in mind that
Yeah.
summers are tend to be very choppy. Almost most asset classes. But I think what's really interesting is where the equity markets are at and whether or not we can continue to forge new highs. So, Jim, next
Yep.
week is going to be a big week with CPI. If somebody wants to get your technical review ahead of the CPI, what's the best way for them to do that?
Jim Welsh, macro at Gmail, and I'll send you next Monday's weekly technical review.
Jim, I want to say it's always great catching up with you at the end of the week. And I want to thank you for spending your time here on Trader Summit. If you guys enjoyed it, make sure you give Jim the thumbs up. Jump down in the comments if there's anything that you're looking at. I know Jim looks at those comments and reads them. So get down there, tell Jim thank you, and I'll say thank you. So thank you, Jim, for spending
Oh,
your time with us.
you're welcome. It's
All
a
right.
joy to be with you.
Same here. Have a great day and have a great weekend. I'll catch you next week.
Thanks, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.